Welcome to the deep dive. Today we're taking the fire hose of data on the auto manufacturing sector and really trying to distill it down to three essential and, wildly different takeaways.
That's right. We put the whole industry through the screeners, and what came out was, well, it was a perfect spectrum study. We're looking at the undisputed growth giant, Tesla, which is ticker TSLA.
And then the legacy value contender, Ford, ticker F.
And the microcap wildfire, FLYE group, that's FLYE. It's a journey from a $1.43 trillion market cap all the way down to 25 million in a single deep dive.
So our mission today is to really understand the different philosophies baked into these valuations, growth versus value versus just sheer volatility. We'll do that by dissecting their fundamentals, the technicals, and some of the critical news flow.
Yeah, we'll connect the metrics to the narratives. Now, before we get into the numbers, just one quick thing. Remember that all the data we're discussing today is based purely on published sources, and it's for, educational analysis only. This is not personalized investment advice. We strongly, strongly encourage you to do your own thorough research before making any decisions.
Absolutely. Okay, let's hit the accelerator and start with the biggest name in the cohort, Tesla.
All right, TSLA. The scale is just, it's immense. A market cap over $1.43 trillion, and it's trading around $430 a share.
But to really get this company, you have to look right past that scale and straight to the valuation.
Exactly. When you see a PE ratio sitting at an eye-watering 287.
287?
Yeah. You are not looking at a car manufacturer. That PE, it implies that the market sees Tesla not just as an automaker, but as a software company, an energy company, an AI giant.
It's a massive bet, isn't it? A bet that the whole robotaxi thing and full self-driving profits will, actually materialize and just redefine profitability in the next few years.
And the forward PE, it drops a bit to 195, so there's some growth expected. But that price-to-sales ratio of nearly 15, that just confirms the extreme pricing. For every dollar of sales, the market values the company at almost $15.
No traditional industrial company gets that.
Not even close.
But let's challenge that growth narrative with what's happening right now. Sales Q over Q growth is up 11.57%, which is healthy.
It is.
But EPS this year is down a lot, dropping over 31%. A sales increase, but a profit decrease. That smells like something's up. Either pricing pressure or maybe R&D spending.
You hit the nail on the head. That margin compression is a crucial signal. It tells us that scaling is getting expensive, or that these pricing wars are finally hitting the bottom line.
Okay, but on the other hand, their balance sheet is.
Oh, it's stellar. Their financial health is fantastic. Strong liquidity, a quick ratio of 1.67, current ratio over 2. And for an industrial company, their debt is remarkably low. Debt to equity is just 0.17.
So they have the financial firepower to fund that ambitious future.
Absolutely.
So if the fundamentals are sort of a mixed bag, great balance sheet, but some profit compression, how's the stock actually performing?
Well, the technical data shows you the power of momentum. This stock is, highly volatile. The beta is 1.88.
So it's a rocket ship on a good day and a falling knife on a bad day.
Exactly. And recently, the short-term performance has been strong, up almost 10% for the week and over 30% for the quarter. Right now, it's kind of fighting for direction, just above its 20-day moving average, but a little below the 50-day.
And this volatility is just fueled by these completely opposite news narratives. On the bull side, you've got analysts tying the stock to AI and the whole Magnificent Seven thing. You've got Elon Musk pushing the robotaxi expansion, getting his pay package approved.
Right, cementing his focus. But the bears have concrete data. You see people like Michael Burry publicly calling the stock ridiculously overvalued.
And more importantly,
that's sales data from Europe. It's a real counterpoint. November registrations plunging over 50% in key markets like France and Sweden. That suggests even the promised future is hitting some friction in the present.
Wow. So to put that weekly return, that 9.98%, into perspective, if you had hypothetically put $5,000 in at that price of $430.14, you'd have picked up about 11 shares.
And that 1 week return, that 9.98%, it means that paper investment would have already gained you roughly $499.
Right.
It just shows you the velocity that's possible when the market buys into that future story, even if current events are complicated. It's pure speculation on future dominance.
Okay, so now we shift our focus and our philosophy dramatically. Let's talk about the legacy value contender, Ford. ticker F.
Right. And we jumped from a $1 trillion valuation down to a market cap of, what, 52.44 billion? The price is just $13.16.
This is where we examine current assets, tangible income.
Ford is a classic value profile. The valuation ratios are disciplined. They're based on current earnings. The PE is 11.28, and the forward PE is even lower at 8.94.
And the price to sales is just 0.28, price to book 1.1. I mean, these are fractions of Tesla's multiples.
Exactly. This is where you buy assets in current operations, not a 20-year vision.
And unlike the growth stocks, Ford actually pays you to wait. That estimated dividend yield is pretty substantial at over 5%.
Yep, about 66 cents per share annually. Now, looking at their financial health, you have to contextualize the numbers. Return on equity is solid, over 10%.
But the leverage is high. Debt to equity is 3.47.
It is, which is typical for a massive industrial company. But, and this is crucial, that high DE isn't necessarily a red flag here because a huge chunk of that debt is on the balance sheet of Ford Credit.
Their financing arm.
Exactly. It's fundamental to how they sell cars all over the world.
And their recent growth has been really significant. EPS quarter-over-quarter surged, 172%?
An incredible number, and sales were up over 9%. It suggests that despite all the pain of the EV transition, their legacy business is performing really strongly.
And analysts are projecting nearly 40% EPS growth next year.
Technically, the stock is showing strong, sustained momentum. Its performance over the last half year is up almost 32%.
The RSI is pretty moderate too, 54.93, so it's not overheated yet.
No, and it's trading comfortably above all its major moving averages, the 20, 50, and 200-day. That indicates a really clear bullish trend as it gets close to its 52-week high.
The news narrative for Ford, though, is all about managing that EV transition, and it sounds like it's proving painful. There are reports they might be scrapping or at least scaling back the electric F-150 Lightning plans.
They're facing that EV winter head-on. But they are making some massive commercial moves to redefine their future. That new partnership with Amazon to sell used cars online, that could be a game changer for the entire used car market.
And I saw the CEO's recent warning about job vacancies, these high-paying $120,000 tech roles they can't fill.
Yeah, that really highlights their struggle to transition their workforce from legacy manufacturing to, high-tech software development. It's a real challenge.
So let's illustrate the different nature of this return. If you hypothetically invested $5,000 at $13.16 a share, you'd acquire around 380 shares.
And if that investment were to replicate its steady half-year return of about 32%, the paper gain from price appreciation alone would be about $1,593.
And you have to add the dividend.
You have to. You factor in that 66-cent annual dividend, and those 380 shares would also generate about $250 a year in income. It really shows you the power of compounded returns plus income. It's a stark contrast to the pure velocity of a growth stock.
Okay. Finally, we arrive at the third company from our screener, the microcap wildcard FLYE Group, ticker FLYE.
And if Ford and Tesla are about strategy, FLYE is about sheer speculative volatility.
Right. This is a tiny operation, a market cap of just $25.76 million.
Yeah, they specialize in niche urban mobility, so smart electric motorcycles, e-bikes, scooters. The brand is FLYE e-bike. But since they're losing money, there's no meaningful PE ratio or anything like that.
The financial health is pretty concerning. It's indicative of a young, super high-risk company. We're seeing negative earnings per share, severely negative return on equity.
Profit margin is deep in the red. But what's really unusual is the gross margin. It's exceptionally high at over 41%.
So when they sell a bike, the profit on the bike itself is good.
It's very good. But the overall operational overhead is just drowning all of those gains.
And institutional ownership is basically 0, 1.3%. But insiders own a lot, over 18%.
But the reason this stock is even on our radar is purely technical. The volatility here is historic. The 52-week range is absolutely staggering. From $3.83 all the way up to 166 stats.
That's not a stock. That's a lottery ticket on a roller coaster.
It really is. And the volatility is an active event. On the day we ran this analysis, the price change was an astonishing 252%.
252% in one day.
On a relative volume surge of over 422 times the average. This kind of explosion, and it happened without any clear news catalyst, it's driven by pure technical momentum, short squeezes, and, speculative frenzy.
Which is always accompanied by trading halts.
Multiple trading halts, just to let the market catch its breath. The RSI is flashing a deep red 70, confirming the stock is extremely overbought and overdue for a major correction.
They do have some positive business signals, right? Expansion into Boston and Mexico, a partnership with the NYC DOT for an e-bike trade-in program.
They do, but those seem to be completely irrelevant to what the stock price is doing.
Why is that?
Because the narrative is utterly dominated by massive legal risk. The news feed is just saturated with reports from multiple major law firms urging shareholders to contact them about securities law violation lawsuits.
So there's significant legal uncertainty from its IPO back in June. That's the real risk factor here.
That's the whole story.
Let's just illustrate the kind of speculative potential this volatility creates. Let's assume a hypothetical scenario where you invested $5,000 at the previous day's close of $4.48. You would have gotten about 1,116 shares.
And if the stock then jumped to that close of $15.79 in a single session, the paper gain would be over $11 per share. That would translate to an estimated profit of roughly $12,622.
On a $5,000 investment.
On a $5,000 investment. It just vividly demonstrates the nature of microcap trading. Huge risk, but immediate, explosive theoretical returns driven entirely by short-term forces, totally disconnected from any fundamental value.
What an incredible contrast across one single sector. We've got three vastly different models. Tesla, the growth and vision bet, demanding that PE premium of 287 for flawless execution.
Then there's Ford, the value and transition play, offering current earnings and a substantial dividend at a PE of just 11.
And FLYE Group, the pure volatility trade driven by technicals and legal uncertainty.
The key takeaway for you, the listener, is the philosophical difference in what you are buying. When you select Ford, you accept slower returns, but you get tangible assets and current income.
Whereas with Tesla...
With Tesla, you're paying 25 times more for every dollar of current earnings. You're paying for AI dominance, for potential energy market disruption, for the future.
And with the wild card, you're just buying the potential energy of speculation, where legal filings or short-term trading forces are way more important than how many e-bikes they sold last quarter.
Right. And the auto industry seems to be consolidating between these two extremes. Companies priced for pure technological dominance and companies priced for massive current tangible value. So this raises an important question for you to consider as you digest all this.
Or that.
Given the current high interest rate environment, which of these underlying philosophies, pure future speculation or current tangible value, is more susceptible to being severely punished by a sudden economic downturn or an unexpected shift in policy?
A great question to end on. Thanks for joining us for this deep dive into the value, the growth, and the sheer volatility of the automotive world. We'll catch you next time.